Right, good morning everybody. How are we doing? Thanks for joining me, guys and girls. Happy Valentine's Day and all of that. Morning. Morning, Dave. Morning, Cliff. Alright guys, so yeah, thank you. Many hugs and kisses. It's a little awkward to begin the day. Thank you for that. Yeah. It starts off with an unusual touch. Alright guys, how are we doing? Thanks for joining me. We're going to talk a little bit about trading psychology today, and this is, like most of my webinars, this is an open forum. Alright, so we're going to sort of have a tentative theme here, and then I'm going to throw it out for discussion, and we'll try to soak up the 45 minutes with some worthwhile information. Okay, so, as usual, mass participation will make this a better webinar. Alright guys, so my big philosophy with trading psychology has always been denial, denial, denial. And what I mean by that is, the more one tends to talk about the problems you have, the more they become a self-fulfilling prophecy. Alright, now, the psychology, and I'm not qualified in any way, shape or form to talk about psychology matters, but I think that there's a couple of learned things one gathers over the years, psychology-wise, for trading, because there's definitely 3 or 4 major components to trading in any way, shape or form, right? One of them is your analytics, right? How good are you at analyzing which way things are going to go? 2 is the actual mechanics of trading that. Money management, how you're going about translating that information into money, right? It's one thing to have a good idea of where it's going. It's a whole different ball game to actually make that into money, isn't it? And then the other component is just psychology. Have you got it between the ears to make that happen? Alright? And I've always maintained that, how I always like to use there should be sound. Yes. Yes. There should be sound. Oh. All attendees. Sound is good. Okay. Just crackling. Is that better? Is that better? Alright, so okay, thank you. Alright, so my point here with all of this is that, to me, psychology is something that one develops. I don't think, alright, I mean, I'm sure just like anything, some people are born with an aptitude to be mentally tougher than others. But I think that trading psychology is something that is practiced, something that one gathers over time. Alright, that sort of mental fortitude for trading is not something that one is necessarily born with. Alright, so I want to start by saying that right out the gate. So if you think, how long does that take to develop? Well, I think that depends on the person. For me, I would say probably 2 years. But it takes some time, It's like saying, how long, if you wanted to become a competitive swimmer, how long would it take you to develop a swimmer's build? Right? If you're Dave Lang, it's not going to happen. But if you're a guy like myself, it could happen fairly quickly. right? Never in a million years. Right. But you get my point, right? So the first thing with psychology to me is be realistic about the expectation you have. Be realistic about the expectation you have about how long it's going to take for sort of a trading mindset to happen. Alright, so there's a couple of things that I wanted to talk about today that everybody's aware of, but I'm going to make you more aware of them and then try and give you some pointers as to how to overcome those things. Alright? Right, so, just like I said, trading expectation, or like I said, expectation on how long it takes one to develop that trading mindset. Would you guys agree with that? I mean, I just don't think that one is necessarily, I think that we can develop technical skills, and I think that we can develop money management skills and these different things, but I think we don't necessarily are just gifted with this trading psychology aspect that I think people expect. So, the first kind of rule of thumb is just be kind to yourself. I remember, this is my this is my 7th year of trading, and I remember many days and nights of having conversations with myself in the bathroom mirror, where you just know what's going on, but you still can't seem to make it into money. And that's an exasperating, sort of frustrating thing, isn't it? Alright, so, to me, the biggest vexing thing with trader psychology is expectation. Alright, to me, this is the biggest problem. Okay, because expectation adds pressure, and expectation adds the mirror chat. We've all had it many times, right, Paul? Many times. Many mirror conversations. They're not the friendliest either. They're actually fairly hostile. It's more of an interrogation than a conversation. Alright? So, anyway. So my point being here with all of this is, let's talk a little bit about expectations with regards to your trading, and then how that sort of manifests itself psychologically. Okay? Because to me, the hardest thing to overcome is FOMO, right? The fear of missing out. Have you guys met Mr. FOMO and Mr. Hindsight? Right. Jano, I aim for at least 90% a day. If I can't make 90% a day, I'm a failure. Yeah, no, I'm kidding. Obviously. FOMO and Captain Hindsight, Poiki? Okay. So, we all have these ambitious ideas of trading, right? And we do our thing, we learn hard, we invest a ton of money and ourselves in it. Yes, of course, it's a joke. And what is, for most of us, alright, and obviously I can only speak for myself. Yeah, don't worry about it, just roll with it. We're just rolling with it. For most of us, we have unrealistic initial expectations. Alright? So if your goal for the day is 20 pips, actually scratch that. Let's say your goal my general rule of thumb is take your expectation and halve it. So if your goal for the day is 30 pips, your reasonable expectation should be 15, and there's a method to my madness. If your expectation for the day is 50, it should be 20. Alright, and that's not half. That's a little more than that. And the reason why I'm bringing this up is reducing one's expectation is 100% going to help you. And I'll tell you why. Okay? If, let's say, for instance, I'll pull this up. Now, we obviously got session by sessions to worry about, and we're not all trading 24 hours a day. But if I just show you this a second, okay, let's say that you are watching, these are average daily ranges of the last 10 weeks. Okay, let's say that you are watching the euro, the pound, euro yen, I don't know, not even pound yen, and I don't know, maybe, I don't know, let's say Aussie dollar. Where's Aussie here? No, but this is what I'm saying is that it should be right. Okay, it does depend on capital. Okay, so $300 for some people might be 2 pips. $300 for somebody else might be something else. All right. My point being is not necessarily even the pip total or your monetary total. What I'm trying to say is one's expectation should almost be negligible. All right. So let's say you're watching the euro dollar, you're watching the pound, you're watching euro yen, which is pretty common, and Aussie. 4 pairs. Okay, 4 pairs. So 60, 100 pips euro, 100 pips pound, that's 200. We'll call it 350 with euro yen, 400 with Aussie. 400 pips, roughly, is what's flashing in front of your eyeballs every day. And these are just daily ranges that might be up, down, and sideways. But 400 pips. Okay? And now let's say you're only trading 5 hours of that day. Okay? So let's say that you're exposed to 150 pips worth of price movement. Which is, you and I both know that if you're going to trade for a portion of the day actively, you need to be around a significant market. Whether that's New York, whether that's London, whether that's Asia, you need to have that market open component there, I would think. Right? Commonsensically speaking. Whether that's London, whether that's New York, whether that's both. Alright? And this assuming you're an intraday sort of trader. Alright? So 150 pips. So if I said to you, you need to capture, I don't want to be 15 pips, so 10% of that. 10%. Okay? Well, 10% is still fairly ambitious, but said differently, you are leaving out 90%. This is what I want you to think about. Not what can I make, it's what can I disregard. Okay? I can disregard 90% of this market going in front of me and still be a massive success. In other words, picture yourself working for your boss, for the man, and you screw up 90% of your job. Just absolutely make a terrible mess of it. I need those financials for next month, and you just muck it up completely. However, you get 10% right. And your boss goes, Toby, promotion for you. You're a 90% failure. US mail. Right? You're a 90% failure, and I'm going to promote you. Boom. Right? So my point being with this, however, is if you can fail 90% of it, if you can not take 90% of the market and be successful, and I don't have to prove to you the validity of 15 pips a day. Okay? If you can be successful with that, there shouldn't be a lot of FOMO pressure, should there? FOMO, fear of missing out. Think about that. So this, to me, is the single biggest psychology thing that one can get in one's brain. Right, and I'm not talking about the mechanics of trying to make this 15 pips, or the averages, or losses included. Okay, in reality, you have to shoot for more like 30 to get 15 because of other things going on. Right? I'm just talking about a generic level of expectation that, to me, is critical to adopt. All right. So my point being here, though, is what adds pressure in trading? What adds pressure is pressure to me comes from a work from home. Pressure for me comes from fear of missing out. Because what does fear of missing out do? It makes you do stupid stuff. Right? So here's what happens. Here's a classic example. Okay, yesterday one of our trade plans was to short this euro yen. Okay, we missed this initial drop. Okay, then price came back right here. Okay, and we said to ourselves in class, well, it may drop from here, but the weekly central pivot was right here. And we sat and we looked at it and we thought, well, our target's 2380. Right? Our target's 2380. I don't think I want to short this at sort of 2520 with the weekly central at 90. The failure is like 20 pips away after execution of things. There's no room. However, I have it on good authority that we're going down 100 pips. So I like the trade plan, but I don't like the packaging. But now my level of expectation is only I'm trying to make 15 pips. I caught this trade, but I'm cutting to a different story here. So my level of expectation is I only need to make 15 pips. So I like the trade, but I don't like the packaging. So without hesitation, we just go, oh, I'll just wait for something better. Or I'll just wait for something different. I'll just wait for something else. Why? Because there's no pressure. Does this make sense? Because my level of expectation is so low. It's a defeatist sort of level of expectation. As opposed to sitting there nail-biting thinking, I have to make money today. I have to make money now. I am sitting at the computer, I've got to make money now. Right, so Thursday the 14th, Valentine's Day of 2013, should not be a memorable trading day. Neither should the 15th. Neither should the 12th. Well, just the support for me, well, this was a little Audi change of trend and a big fat double top failure at the fib of the drop and weekly resistance and things. Let's hit the target. I had 2380 in mind. We're going further, but that's what I had in mind. I'm going to limit it out. This is just a demo I was showing people the trade at the time. Okay. So my point being is this, guys, and this is a psychology lecture, so bear with me. Alright, so my point being, though, is with this reduced level of expectation, the fear of missing out, which to me is the root of all psychological evil for us traders, is greatly reduced. Okay, because what are some of the major psych things that most of us deal with, okay? Hesitation around pulling the trigger. Right, because here's what happens. Tell me if this sounds familiar. Okay, tell me if this sounds familiar. If you have, how many of you look at it this way? You think to yourself, you look at the end of the day, and you might have 4 or 5 trade plans, of which your trade plans have been 70% accurate. I'm not trading a demo, Boyke. Okay? Demos do not pay mortgages. So, okay. So, my point being, okay. So how many of you look at it this way? You'll have, say, 5 trade plans for the day. And you'll look at the end of the day and you've taken 3 trades and you've lost money. However, for the most part, your trade worked out. And what's happened is that you've reacted to other things as opposed to just trading your plans. Right? And I'll get to your questions in a sec. This is something that I've seen over and over and over again. So my point being is this. Okay, my point being is this. Is that what happens, though, right, happens all the time. And as a result, one takes a mental beating, even though you're actually right. So you've actually hurt yourself by trading outside of your trade plans. And as a result, your brain never gathers a positive association to what you're doing. So that even when your profit trade plan comes along, you're so mentally desecrated that you don't take your trade plan on time. And then you have a poor entry, and now you're stuck with an unmanageable trade that you don't really trust because you've eroded your confidence on stuff that you shouldn't be taking in the first place. Okay? So, the fortitude to only trade your plans will be a knock-on positive effect for all your other psychological issues. Right. So that's what happens. That's what happens, is that you don't take... Alright, so one of the truest things said is this. Let's say that you're a 50% successful trader, which should be enough. 50% of your trades work out. With risk-reward and adding to winners and letting profits run, etc., 50% should be enough. Okay? But you don't know in which order your trades are going to be winners. You just know over a 100-trade period, you're probably going to be right 50% of the time. Okay, so you might go something like this. 10 trades, win-win, loss, 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 win, 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 loss, loss. It's 50%. Next go around, you go loss, win, 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 loss, 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 win, win. So the sequence of trades, both of these are 50%, but the sequence of winners and losers is unknown to you. So if you start to pick and choose your edge, what happens? Murphy being Murphy, you take these trades. And you skip the good ones. Because what happens is that you're trading around your trade plans in a reactive fashion because fear of missing out has gripped you. And now you're wanting too much confirmation on your stuff, and that's exposing you to too much risk. Then you get reactive on the management, and then it starts to work, or you cut it, you micromanage yourself out of it, and it starts to work for you, and you jump back in it, and now you've jumped right back in it at the reversal point, and now you're taking more losses, and it's not good. Okay? And then as a result, you have all this anxiety about, oh, is this next trade the loser? And, oh my goodness, I'm 31 pips in profit of something I know should run 150. Let me take profit. It's all a product. It's all a product of fear of missing out. It's all a product of too high a pressure and too high expectation on yourself. And it's all a product of not staying disciplined to only trading your plans. Right, so this isn't, none of this stuff's easy. And I'll give it on, I want to say on Monday. Might have even been Friday of last week. I think it took 3 consecutive losses. I was down almost 60 pips for the day. I was one trade away from it being a bad day. Really bad day. But then the 4th trade was a Euro-Yen trade that ran for 150 pips, and everybody felt good about it. But in the FX Bootcamp room, there was a lot of silence going on. There were not a lot of people talking, and I always know that that is a lot of OMG. What is going on? Well, I think the first thing is what I talked about right up front, is that expectation level. Is sometimes it's better to scribble your trade plans down. Sometimes just the mechanics. Yeah, a little bit, Dave. Sometimes just the mechanics of writing that stuff down is, automation's one side of it. Some people might just benefit from automation a little bit, because then it's just, hey, it's mechanical, right? You just take your edges when you see them. To me, sometimes just the mechanics of writing your trade plan down takes the pressure off you, because then you say to yourself, right, is this within the tolerance of this trade plan? Obviously, if price is at your level within 5 or 6 pips or something, you're going to take the trade. You should. Right? Sometimes that trying to be too perfect too is also a product of fear of missing out, because you've been so beat up from your previous trades that you try to be too perfect now on the stuff that you want to take. That also just boils right back to you've traded reactively as opposed to proactively, and then that's compromised you in terms of your confidence. The other thing too that can hurt is flip-flopping around too much between methodologies. Because what happens is that you just get to a place where you're about break even on something, and then the next silver shiny thing comes by and you're like, oh, well, that looks better. So then you circle back to a different methodology and system of trading, and now you don't truly know what works for you. right? You've never allowed your brain to settle into something that you can make a positive association to. So you don't truly know what's working for you and what's not. So, my advice there is settle into one or two things and be happy with it. Nothing's perfect. Yeah, we need to catch up, Cliff. I keep saying that, but we do. Right? Nothing's perfect, is it? There we go. I mean, that can be a major, learning too many different things can be a major problem. Because you don't know what's working for you and what's not. So you have no confidence in any one thing. Alright? So in summary, lower expectations, have the discipline to only trade your plans, okay? Because then 3 losses in a row isn't going to derail you. You'll continue to take your edges because you know those are your designated plans. Alright? These are things that over time will instill some confidence in you. And I can tell you as many times as I can tell you until I'm blue in the face, trade without emotion, trade like it's your job. Okay, dude. Whatever. It's ridiculous. We're human beings. Right? We're human beings. We're dealing with hard-earned money here. You're dealing with pride and ego and fear and greed and all these other different, and doubt. So the only, I think it's best to acknowledge that and deal with that as opposed to just ignore it, because you can't ignore it. So that you need coping mechanisms in your life, and to me that's largely expectation driven. Right? Okay. I've got a couple little notes here. Okay, the other thing to me that can greatly help, I'm not ignoring your questions, guys, I'll get to them. The other thing that can greatly help sort of calming your psychology down is having a bias. Alright? So you may not be right on your bias for the day, week, or whatever. Okay, but to me, eradicating one side of the trading ledger is a comforting and relaxing thing on the mind. Okay? No beer chaser. No, you're fine. Alright? So what I mean by this is as follows. Let's say you were a Euro bull today. Okay? I don't know, let's say you were bullish or, above 34 or something. I was seeing a lot of tweets last night about Euro bulls. Okay, which means that you're only looking for buys for yourself. Alright? That is fine to be wrong. Okay? So my advice would be, look to trade in alignment with your bias for the day only on one. Obviously, this depends on trading style. Some people like to go back and forth. I like to just stick with one side of it. I find it just easier. Because what happens is you might get in the buy side of something for 18 pips, and then now you start rooting for the buy side, and you miss the real trade of the day, which was actually the short you had in mind. And then you get stuffed out on your 18 pips for break even, and the trade runs for a country mile on the short that you didn't take anyway. So developing a bias for the day is just as important as anything else. However, having an area that will change that bias is important too. Alright? So you've now eliminated 90% of the market in terms of what you don't need to take. And you've actually cut that down a little bit more in terms of only trading one side of it until such time as a level is broken and you change your bias. So if you are a bull, you only buy at support, only buy at support, only buy at support. Oh, support's broken. Right. Has it got short potential? Yes. Wait for a retest, take a shot, or not trade at all. Make sense? And what I was saying, I lost my point a little bit earlier on, but you'll be surprised. You'll be surprised as to what a difference it makes if you just write stuff down. Because then what you've written down is your trading psychology. It's right there on the paper. Okay? So if you're thinking to yourself, well, I'd like to short the Euro-Yen at 25.40 and it's sitting at 25.20. You know, is that within, say, a 10 pip area or 15 pip area? No. Fine, I'm not taking it. Oh, it gets in my area? Oh, okay. Alright, a little bit of... okay, I'm gonna take it. Right, now where does my stop? You know, so your trade plan is going to be entry, stop, brief message on money management. How you going to, you know, what do you need to see broken to go to break even? What would get you out of the trade, a level broken or a defined stop? Alright? And then, you know, where your target is. The other thing is, you know, we'll talk about exit here in a minute, which to me is the hardest side of it all. But then, you don't need to do any thinking when you're in the trade. Because you're going to do... Bruce Kovner talks about this. Bruce Kovner was one of the biggest currency traders in the world. Managed hundreds of millions of dollars, made tens of millions of dollars. Right, and he talks about sometimes he would just get out of trades to think. And then get right back in them 5 minutes later. To think. Bruce Kovner. Kovner. Right, he'd get out of them for 5 minutes just to think. Because one tends to not think as objectively in a trade. So if you have it written down prior to, most of it's there. I think so, Dave. Most of it's there as a little roadmap for you. It's interesting. Okay, so then let's talk about exit. So what I've done here, guys, is I've just highlighted problems and then just mindsets to help overcome these problems. Okay, and just taking the pressure off yourself, to me, is the very biggest step you can take. Don't put so much, be kind to yourself. Don't put so much pressure on yourself. I'm sure. Okay, so what about exit? You guys are going to think, what about exit? To me, exit is the hardest thing of them all. Because if you exit too soon, inevitably the trade runs. And if you don't exit soon enough, it comes back and chews up your profit. Right? I mean, that's just how it is. So exit, more than anything, I think is about I've mentioned this before, sort of a dynamic assessment of risk-reward relative to your target. So you're saying, do I want to risk 30 to get 20? Probably not. Do I want to risk 20 to get 10? Probably not. So then kind of keep adjusting your stops relative to that risk-reward. And then just be comfortable with the fact that very, 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 very seldom are you going to be able to pick the bottom of the market or the top of the market in terms of your exit. Does this make sense? And I think just realizing that's kind of a big deal. Because that can be a massive sense of frustration and greediness for the next time. I can sit here until I'm blue in the face and say, well, you know, I don't want to talk about, today's not about mechanics of how to define an exit. I'm just purely talking about talking about psychology and expectation, because I can help you, you know, in other webinars we can talk exclusively about exit. Happy to spend 45 minutes on it and more. Alright? And that's basically all I have for you today. Lower your expectations. Have a bias. Trade only your trade plans. If you for 1 second are getting reactive, just let it go. Okay? Just let it go. And Boyke, your question about trading psychology and trader psychology, I don't know. I mean, I'm sure there's a distinction. I just don't think I'm smart enough to make that distinction. Ahmed, I don't think so. I mean, is FX a scam for small people? No, but I think that people set themselves up for failure. You know, I really do. We can talk philosophically, but I just think that people market psychology and trader psychology, well, I think they're fairly, you know, I know there's algos and things that face now that there probably weren't a few years ago in the great masses. But, you know, I think the biggest representation of market psychology is that every trend is going to surprise you, and every range is going to surprise you. So don't be surprised at surprising things. You know, and it's about just, to me, it's all about just controlling what you can control and being okay with that. At the end of the day, I mean, we're risking money here trying to predict the future. Anyway, I'm jumping around questions, and that's probably not what you're looking for, Boyke. I just don't have a particularly good sort of answer for you, to be honest. Well, Ahmed, I don't believe that, though. I just don't believe that, because banks and smart money are you and I. I'm not saying we're trading for banks. I'm just saying that why are those people smarter than you and I? I don't think so at all. I mean, UBS or Deutsche Bank just got bust for 12 billion in trading losses. The numbers are just bigger. What happens is that they have these micro hedge funds that they break off from their banks as entities and then go and either balloon them or blow them up. And then they just move people around and start it again. And just rinse and repeat. And if they hit it, they hit it, and if they don't, who cares? It's just somebody else's money. We'll just get more from the big pool of mutual funds and loans. Right. So, in my humble opinion, we give the smart money way too much credit. Way. I think you can make a good living, but I think, and I've run out of time, but I think you can make a very good living from it. But I think you've got to be realistic about it. right? I think you've got to be realistic. If you're expected to make a living, no matter how much money you're starting with, in 2 years, of trying, I really think you've got an unrealistic expectation. I'm talking about 2 years of every day. I mean, the very first thing we talked about today, wise, was, hey, how long does it take a swimmer to get a swimmer's physique? It's going to take you that long to develop your brain. Years. Okay. Anyway, guys, I've run out of time. We can talk about this for a very long time. Once again, I very much appreciate your participation. It's what makes these things successful. And if I didn't get to your questions, I apologize. David at fxbootcamp.com or at ForexDavid on the Twit. And thanks for your support, guys. If I can just give myself a plug, the little survey about good contributors would be nice. Yeah. Alright, guys. We'll talk to you soon. And happy Valentine's Day and take care.